While you were trying to pick the right stock, someone who did nothing passed you by. Not a hedge fund manager. Not a Wall Street professional with a Bloomberg terminal and a team of analysts. Just an ordinary person, a teacher, a nurse. Someone with a completely normal income and a completely normal life, with a quietly growing investment running in the background, while sleeping, while working, while worrying about everything else. Here's what will bother you. They didn't do more than you. They did significantly less. And for decades, they've been outperforming the overwhelming majority of professional investors. I want to show you exactly what these investments are. But more importantly, why is your brain wired to ignore this? And why are the people who profit most from your financial decisions so confident you'll keep ignoring it? We'll get into all of that today. But first, I need to tell you something about how the financial industry actually works. Something most people inside that industry would prefer you never fully understood. Stay with me because by the end of this video, you'll see something about money, investing, and your own financial behavior that almost no financial content ever explains clearly. And I've saved the most surprising part for last. My name is Maya. I think about the gap between what people know about money and how they actually use it. And what I keep finding over and over is that the most powerful tools available to ordinary people are almost always the ones they overlook, not because they're hidden, because they seem too simple to be real. Please stay with me on this because later in this video, I'm going to share a real, documented number that most people don't believe the first time they hear it. And once you understand what that number means for your own money, you'll never look at investing quite the same way again. Let me ask you an honest question. Have you ever felt a low-level anxiety? No matter how hard you work, no matter how carefully you manage your money, that it never quite feels like enough? Like you're running on a treadmill that keeps speeding up and the finish line just keeps moving further away. If your answer is yes, leave a comment right now. Just write yes. Because what I'm about to explain is directly connected to why that feeling exists and why so many people share it. Most people approach investing with effort. They research stocks, follow financial news, try to time the market. They look for the right moment, the right company, the right opportunity that everyone else somehow missed. And here's what I need to say clearly. Because most financial content dances around this, that approach, the active, effortful, I'll figure this out approach is almost always worse than doing nothing at all. The data on this isn't ambiguous. It isn't up for debate in any given year. The overwhelming majority of actively managed funds underperform a basic index, not because the people running them are incompetent, because the market incorporates information extremely efficiently, and consistently beating it is genuinely difficult. I'll come back to that specific number in a moment, and I promise it will surprise you. But first, there's something the financial industry will never say out loud. The financial sector makes money when you buy and sell. When you switch funds, rebalance your portfolio, follow advice from someone charging a fee. Every single one of those moves generates income for someone in the chain. Every moment of uncertainty that turns into a decision is an opportunity for a fee to be collected. What nobody tells you is this: the quietest investment strategy is also, historically, the one that has delivered the best results for ordinary people over long periods of time. This is called passive investing, and its primary vehicle is something you've probably heard of but may not fully understand: an index fund, or its close relative, the ETF. Now, I want you to notice something when I say index fund. Part of your brain might already be pulling back to boring, to simple. Surely it can't be that straightforward. Hold on to that reaction, because that reaction is exactly what this video is about. That reaction is precisely why most people walk right past the investment that's quietly making others wealthy. And that reaction is exactly what the financial industry is counting on. An index fund doesn't try to beat the market. It is the market. When you own a broad market index fund, you own a small piece of hundreds, sometimes thousands of companies at once. As those companies grow, you grow with them, automatically, without picking a single stock, without following a single headline, without making a single active decision after the initial one. The system simply runs. But this is where most people freeze, and this is where psychology completely changes the picture. Your brain doesn't find this satisfying. I'm not saying that as a criticism, I'm saying it as a fact. A well-documented psychological reality that, once you understand it, is worth more than any stock tip, market forecast, or financial newsletter you'll ever come across. It's called action bias. It's why people consistently choose complex, effortful approaches over simple, automatic ones, even when the evidence clearly shows the simple approach produces better results. Think about it this way. Imagine two options. Option 1, you spend significant time researching companies, tracking market movements, reading financial news, adjusting your portfolio as your thesis evolves. Looking for businesses poised to outperform. It feels like work. You feel engaged. You feel like you're doing something meaningful. It gives you a sense of control. Option 2, you set up an automatic, regular contribution to a broad market index fund. Once you don't touch it again. The system runs whether you look at it or not. You get on with your life. Which one feels more like investing? If you said the first, which most people do, that feeling is the problem. Not because you made an irrational choice, but because your brain has spent years being trained by financial media that treats investing like a sport requiring constant participation, rewarding action and complexity, to believe that more activity means better results. That's not how it works, almost never, and the real cost of this belief isn't dramatic losses. It's the slow, invisible erosion of returns through friction, compounding quietly against you over years and decades. That's where the damage lives, not in bad decisions and friction. The difference between someone who builds a simple, automatic system and leaves it alone versus someone who constantly adjusts, times, and manages. The first group quietly grows their wealth without looking at a single stock chart. The second group works harder, makes more trades, pays more in fees and taxes, carries more psychological stress, and statistically ends up with less to show for it. Being boring in investing isn't a flaw, it's a feature. Now, the number I promised you, here it is. Over a 15-year period, more than 90% of actively managed large-cap funds in the United States underperformed a simple S&P 500 index fund, not 50%, not 60%, more than 90% professional managers with every advantage, with every resource doing full-time what you're trying to do on the side. 90%. Sit with that for a moment, because before we go further, I want you to really feel what that means. Let me tell you about two people and pay attention not just to what happened, but to why. Marcus and Elena, same age, same city, similar incomes. Both started seriously saving in their late 20s. Marcus was genuinely interested in investing. He found it intellectually engaging. The research, the analysis, the active relationship with his financial future. He wasn't reckless. He was thoughtful. He read widely, made careful decisions, monitored his portfolio closely, and adjusted his approach when things didn't go as planned. For about 7 years, he did everything a responsible investor is supposed to do. Elena did something that, from the outside, looked almost embarrassingly simple. She set up an automatic contribution to a broad market index fund. Once, she chose a low-cost option. And I'll explain shortly why cost matters so much, and let it run every month automatically. Then she largely stopped thinking about it. No individual companies to track, no signals to read in market news, no compulsive rebalancing, no urge to adjust when things looked uncertain. She just let the system do its job. 7 years later, Marcus sat down and honestly compared the results. Elena was ahead, not by a little, by a meaningful margin. And when he tried to understand why, the answer wasn't that Elena was smarter, luckier, or more disciplined. She had systematically eliminated the three variables that quietly erode investment returns over time. First, transaction costs. Every time Marcus bought or sold, there was a cost, small individually, significant cumulatively. Low-cost index funds carry expense ratios that are a fraction of actively managed funds. That difference compounds over time just like returns do. Second, tax drag. Every time Marcus locked in a gain, it was a taxable event. Elena's buy and hold approach meant her growth continued compounding, largely untouched by taxes. 4 years. Third, and most importantly, Marcus himself. He made a handful of key moves at exactly the wrong moments. Not because he was irrational, because he was human. When the market dropped sharply, he felt the pull to act, to protect what he had, to stop the bleeding. When it rose, he felt confident and added more near the peaks. Understandable. Human. And quietly costly. Elena's system didn't require her to be rational under pressure because under pressure, it didn't require anything from her at all. It just ran. The difference between Marcus and Elena wasn't intelligence. It wasn't financial knowledge. It wasn't character or willpower. It was architecture. But here's where it gets genuinely interesting and honestly, a little unsettling. Even after hearing all of this, why do most people still choose Marcus's path? It's not about information. If it were, everyone who heard this argument would immediately restructure their finances and never look back. But you probably know people who've heard it before and still feel compelled to stay active. Still feel like the simpler option is leaving something on the table. Your brain is wired to equate effort with outcome. We believe that working harder produces better results. That staying busy means staying in control. For most of human history, that instinct served us well. But financial markets are not the physical world beyond a basic level of knowledge. This is a system where exerting more effort actively works against you. Checking your portfolio more often leads to worse decisions. The sense of control that comes from active management is, almost entirely, an illusion. The discomfort you feel about passive investing isn't evidence that you've spotted a real flaw. It's your nervous system associating simplicity with not trying hard enough, with missing out on something. You're not leaving anything on the table. You're removing the very thing that flips the table over. Now, let me bring this into the present, because we're not having this conversation in the abstract. Right now, the economic environment is one of the most psychologically difficult in recent memory for anyone. Trying to make sound financial decisions, volatility, uncertainty, geopolitical tension, policy changes that can move markets within hours, an environment specifically designed, not intentionally, but effectively, to make the urge to act feel completely overwhelming. It is precisely in environments like this that the gap widens most dramatically between those with a simple, automated system running quietly in the background and those actively trying to navigate the noise. People who built passive habits during calmer times automated them and removed the need for motivation to continue. They're watching current volatility without panic. Their contributions run regardless of how they feel about the headlines, and when the market falls, they're buying more units of the same index at a lower price, which is, historically, exactly what you want to be doing. People without that system are making their most important financial decisions under maximum psychological pressure, and decisions made under pressure without a structure built in advance almost never go the way we intend. I want to ask you something. Think carefully before you answer. Right now, today, do you have a system for your money, not a plan in your head? Not an intention to start someday, a real, automatic, functioning system that moves money toward your future self without requiring a decision from you. Each time, leave your honest answer in the comments. Not how you wish it were, how it actually is today. Because the patterns in those answers shape exactly what this channel covers next. Let me address the question that comes up every single time this topic is raised. What if I could beat the market? What if I actually have real insight, real edge, real skill? Some people do beat the market. It isn't impossible. What if I'm one of them? Here's what I'll say without judgment because I used to think exactly the same way. Maybe you could, it's possible. Some people genuinely have real talent here. But here's the honest question worth sitting with. What is the actual cost of running that experiment? It takes years to generate statistically meaningful results. Every trade incurs costs. Every profit creates a tax event. It requires the emotional capacity to watch something fluctuate constantly, and not just watch, but repeatedly make high-stakes decisions under uncertainty. It requires enough knowledge to maintain a genuine edge over professionals who do this full-time. And at the end of that experiment, if the data proves correct, and you find yourself in the 90% rather than the 10, you won't just have underperformed. You'll have spent years of psychological energy, financial resources, and cognitive capacity on something a low-cost, automated, boring system could have done better without any of those costs. This isn't ideology. It isn't active versus passive as an abstract philosophical debate. It's the difference between a financial life that demands constant management, constant decision-making, constant emotional regulation, and a life where a self-running system quietly builds security in the background, freeing your limited psychological energy for the areas of life that actually need your presence. There's one thing most passive investing content completely overlooks, and it's actually what determines whether you'll build this habit or just keep thinking about it. Cost. When I say low-cost index fund, I mean it precisely. The expense ratio, the annual fee a fund charges, is one of the strongest long-term determinants of your actual returns. Not because any single year's fee is enormous, because fees compound the same way returns do. Every dollar paid in fees is a dollar that stops growing for you over a long enough time horizon. That difference matters more than almost any other factor you'll consider. Low-cost index funds carry expense ratios that are a fraction of actively managed funds. Not because they're lower quality, but because tracking an index doesn't require an analyst team, a trading desk, or a commission structure built around activity. Here's what I want you to do before this video ends. Step 1. Today, not this week. Write an honest answer to this question. Does your current approach to saving and investing require you to make active decisions regularly? Or does it run on its own? Not as a judgment, just as a fact. A clear look at the difference between what you actually have and what you think you have. Because until you see honestly what you're working with right now, you can't build something better. Step 2. This week, spend 30 minutes genuinely understanding what a low-cost, broad market index fund actually is. Not to move money, not to make a decision, just to close the gap between knowing about something and understanding it clearly enough to act. 30 minutes. That's it. Step 3. Over the next 30 days, notice how often you feel the urge to do something with your money, the pull to check, adjust, move things around, not because something is wrong, just because staying still feels insufficient. Notice how automatic that feeling is. How certain it seems. You're not trying to suppress it. You're learning to see it. And seeing it clearly, consistently, is what creates a space to choose something different. One honest answer. 30 minutes of understanding. 30 days of observation. There is something hiding in plain sight in the mainstream financial world. It isn't overlooked because it's a secret. It isn't locked away in some exclusive corner reserved for the wealthy or well-connected. It's accessible to virtually anyone with a basic brokerage account. It's overlooked because it doesn't feel like enough. It doesn't create the stories, the excitement, or the sense of active engagement that makes financial participation feel meaningful. In a world that constantly rewards effort with recognition, passive investing offers none of that. There's no story to tell, no thesis to defend, no moment of being right, just silent, steady, automatic growth. But here's the identity shift I want you to consider. You don't have to beat the market to build real financial security. Your financial future doesn't depend on finding the right stock at the right moment. You don't have to earn your way to stability through constant vigilance and action. What you need, like every person who has built genuine financial freedom, is a system that works independently of your motivation, your attention, your available time, or how stressful the current economic environment feels. The people quietly growing their wealth month after month, year after year, without drama or constant management, didn't discover a secret. They stopped looking for one. They built a habit. They made it automatic. They removed themselves as a main variable. And while the system did its work, they got on with living their lives. The investment that quietly makes others rich is deliberately boring, deliberately automatic, deliberately simple. The only real question is whether you'll build it before you feel ready, or keep waiting for a moment that will never quite arrive. You will never feel that the timing is perfect. Build it anyway. One question before you go. Think about the most complex financial decision you've ever made, the research, the analysis, the time and energy you spent on it. Did it outperform doing nothing? Leave your honest answer in the comments. No judgment, I mean that genuinely. Because the gap between the effort people invest in financial decisions and the results they actually get is one of the most important and least honestly discussed patterns in personal finance. And what you share shapes exactly what this channel explores next. If this video gave you something most financial content doesn't, subscribe. This channel exists to close the gap between knowing and doing, between understanding something intellectually and actually building the financial life that understanding should always lead to. And the next video goes directly into something I touched on today: how your brain is programmed to value effort over outcome, and why that programming makes rational financial behavior structurally difficult for almost everyone. Once you understand this mechanism at the depth we'll cover next time, Your entire relationship with money starts to look different. It's already there when you're ready. Watch it next.